Okay, so get this. Imagine if skipping a few lattes every week could, like, lead to having an extra $500,000 later. That's the power of compounding. And it's just one of the secrets we're exploring in this deep dive today. I mean, with this stack of personal finance sources you sent over,
Hmm.
you're definitely looking to, like, seriously up your money game.
It really is amazing, isn't it, how small, consistent actions they can create a ripple effect over time, leading to big financial outcomes. It's like a shift from quick wins to long-term strategies, you know?
Totally. So we're diving into Tony Robbins' book, Money Master the Game, where he's like sharing all these incredible insights from financial titans. It's like your cheat sheet to understanding the rules of the game, avoiding all the like common pitfalls, and really crafting a financial plan that empowers you.
Yeah, knowledge is power, especially when it comes to your finances, right? I mean,
Yeah.
understanding the fundamentals helps you make informed decisions
Yeah.
and, and navigate the complex world of finance, you know?
Exactly. Whether you're just starting out or looking to refine your approach, we're going to break down all these complex concepts into clear, uh, actionable steps. Get ready for some aha moments and thought-provoking stuff and like a fresh perspective on what it really means to achieve financial freedom.
Let's jump right in.
Perfect. So first up, the magic of compounding. Tony Robbins illustrates this with a really compelling story about two brothers. Okay. One brother starts investing at 19, consistently contributes $2,000 every year for 8 years, and then boom, stops completely. The second brother, he starts later at 27, but he diligently invests $2,000 every year for 39 years, almost 5 times longer. So guess who ends up with the larger nest egg?
Well, this is such a perfect example of the power of time in the market. That brother who starts earlier, even though he invests for a shorter period, really benefits from the exponential growth of compounding. And I think that's the takeaway for our listeners. The
Yeah.
sooner you start, the more time your investments have to grow, regardless of the amount.
And you won't believe the difference. The brother who started early, even though he invested less overall, ended up with a staggering 600% greater return. It's that snowball effect of letting your money work for you over time.
Like it's like a financial seed you plant early on. The more time it has to grow, the more it flourishes, right?
Exactly. And speaking of planting seeds, compounding changes the way we view taxes. Paying taxes up front on your investment, your seed, as you would with a Roth IRA, might seem kind of counterintuitive.
But think of it this way. You're choosing to pay taxes on a smaller amount now to avoid paying taxes on a much larger sum later. Because with a Roth IRA, you contribute after-tax dollars, which allows your investments to grow tax-free. And when you withdraw those funds during retirement, you don't owe any taxes on those
Right.
gains.
It's like choosing to pay a small fee at the entrance of an orchard, versus paying a hefty price for every single piece of fruit that you pick later.
Precisely. And when you consider the potential for significant growth over decades, the benefits of those tax-free withdrawals during retirement become even more apparent.
Absolutely. Now, Tony Robbins, he doesn't sugarcoat things.
Mm.
He acknowledges that the financial world is full of opinions,
Hmm.
and not all of them are helpful. So he really challenges us to be discerning about who we listen to, especially when it comes to advice about our hard-earned money.
It's like it's about differentiating between opinions and proven track records of success. Like, would you take fitness advice from someone who's never worked out? I mean, their words might sound convincing, but their actions don't match. You know what I mean?
Yeah. And he actually quotes Oscar Wilde. He says, "An expert is an ordinary man away from home giving advice."
Yeah, that's a great quote, and it really emphasizes the need for critical evaluation when it comes to financial guidance. Don't just blindly follow opinions. Seek guidance from those who have demonstrably achieved, what you aspire to. Look for experience, knowledge, and a genuine commitment to helping you succeed.
Yeah, it's like you wouldn't seek medical advice from someone who isn't a doctor.
Right.
Your financial well-being deserves that same level of care and expertise. So, you want to learn from those who are actually winning the game, not just talking about it.
Absolutely. Aligning yourself with credible sources, and proven professionals can make a world of difference.
Okay, so are you ready to bust some common Wall Street myths? This is where things get really interesting. Robbins reveals how the financial industry uses these tactics to kind of obscure reality
Right.
and make things seem rosier than they are. One of the most common misleading tactics is the concept of average returns.
Average returns can be so deceiving. A significant loss over a few years can be masked by by averaging it with periods of growth. Like, if a fund loses 30% one year, then gains 20% the next, the average return might appear, positive, but you're actually down overall.
It's like saying I lost weight this year,
Yeah.
on average, but
Yeah.
but you're ignoring the months where you actually gained weight. The scale doesn't lie.
Exactly. The average doesn't tell the full story, right? You need to examine the actual returns year by year and assess the consistency of those returns over time. That'll give you a more accurate picture of the investment's performance.
So it's essential to look beyond the marketing hype and really understand how your investments are truly performing. Don't let averages mask those potential risks or losses.
Right, transparency is key.
Now, another myth that Robbins tackles is the allure of mutual funds. And we've all heard those enticing ads promising impressive returns, but Robbins, he drops a bombshell. He reveals that the advertised returns aren't necessarily what you actually receive.
Yeah. So where are those gains disappearing to?
Right.
The answer often lies in the hidden fees associated with mutual funds.
And those fees can eat up a substantial portion of your potential gains. Robbins even suggests it could be as much as 60%. It's like inviting a swarm of locusts to your financial feast.
It's important to remember that even small percentages in fees, when compounded over time, can really diminish your wealth. Take the time to carefully review the expense ratios of your mutual funds and explore, lower cost alternatives.
Yeah, and Robbins recommends aiming for total fees of 1.25% or less, and that includes any advisor fees, along with the costs of the investments themselves. He highlights that there are ways to access expert advice without being burdened by those exorbitant mutual fund fees. He even mentions a website that provides free analysis of your investments and fees, which helps you understand the true cost of your portfolio.
That's a fantastic resource for anyone who wants to get a clear picture of their, their current financial landscape.
Yeah, and he really emphasizes the value of seeking guidance from a fiduciary advisor, someone who is legally obligated to prioritize your interests above their own.
This is a critical distinction, right? Unlike brokers who may be incentivized to sell products that generate higher commissions for themselves, a fiduciary advisor is bound by a higher ethical standard to act in your best interest. They have to recommend solutions that are suitable for your specific needs and goals.
Exactly. And Robbins stresses that finding a qualified fiduciary advisor doesn't have to be expensive. He challenges that notion that these advisors are exclusively for the wealthy. He highlights the increasing accessibility of sound financial advice.
With the rise of technology and fee-based advisory models, quality financial advice is becoming more accessible to a wider range of individuals. It's no longer a privilege reserved for the elite.
Okay. One last myth to bust before we move on. Target date funds.
Yeah.
They sound really convenient, right? You choose your target retirement year and boom, you're all set. But
this apparent simplicity often comes with a hidden price tag. While target date funds streamline that investment process, they frequently carry concealed fees, and those fees can, gradually erode your returns over time.
And Robbins, he shares this compelling story about a Wharton professor who bravely exposed the inherent flaws of target date funds.
Yeah, the professor was initially asked to conduct a counter study evaluating the effectiveness of target date funds as a default retirement option. But during his research, he discovered that the investment company Institute, which is an organization representing the mutual fund industry, had significantly influenced previous research to present a biased view in favor of these funds.
And this professor, he had impeccable credentials. He had worked at prestigious institutions like Goldman Sachs and the World Bank. He even served as an advisor to the Treasury Department. So, it lends a lot of weight to his findings.
His research uncovered potential conflicts of interest within the financial industry and highlighted the critical need to seek independent, unbiased advice when making those investment decisions.
It's a cautionary tale reminding us that convenience doesn't always equate to the best outcome. So don't blindly trust what you hear, even if it sounds appealing. Do your research, ask questions, and make sure you fully comprehend the details of your investments.
Empower yourself with knowledge. It's all about taking control of your financial destiny, right?
Okay, so We've debunked some prevalent myths and really explored the incredible power of compounding. Now let's shift gears a little bit and focus on constructing a robust financial plan. Robbins, he emphasizes this concept of asset allocation, which is essentially creating a personalized roadmap for your money.
It's not just about, randomly dividing your funds between stocks and bonds. Asset allocation, it involves strategically distributing your investments across different asset classes.
Yeah.
And you have to take into account your risk tolerance and your time horizon.
Yeah, and he introduces this idea of three financial buckets. You've
Yeah.
got the security bucket, the risk growth bucket, and my personal favorite, the dream bucket.
It's a brilliant framework, isn't it, for visualizing and organizing your financial goals. It helps you allocate your resources effectively.
Yeah, I love how tangible it makes the whole planning process. So the security bucket, that's where you park money that you absolutely cannot afford to lose.
Yeah.
But here's the cool part. It doesn't have to be like boring or limited to just, traditional savings accounts.
Mhm.
Robbins suggests exploring options like real estate loans or certain types of annuities, which
Yeah.
which can offer a balance of stability and growth potential.
Yeah, this bucket really focuses on establishing that solid foundation for your financial well-being, preserving
Yeah.
capital, making sure you have that safety net for unexpected situations or emergencies.
Giving that sense of security, right?
Yeah.
Peace of mind. And then we have the risk growth bucket. This is where you aim for long-term growth, recognizing that, volatility is a natural part of the market cycle.
Exactly. This bucket is all about participating in the market's potential for growth, while understanding and accepting the fluctuations that will inevitably happen along the way. Diversification, I mean, that's key here, right? Spreading your investments across different asset classes to mitigate risk and capture those growth opportunities in various sectors.
And Robbins even suggests like specific investment types for each bucket, ranging from bonds and real estate to precious
Yeah.
metals and even peer-to-peer lending. It's all about aligning your investments with your individual, comfort level with risk.
It's a personalized approach.
Right.
It acknowledges that every individual has unique financial goals and risk tolerance. There's no one size fits all, solution when it comes to investing.
Now, this is where things get really exciting.
Yeah.
Robbins delves into the strategies of Ray Dalio, the hedge fund titan, right, who manages billions of dollars. And Dalio, he's developed this fascinating approach called the all seasons portfolio.
What's captivating about Dalio's approach, it's his emphasis on balancing risk rather than solely focusing on dollar amounts. It's a concept that so many investors overlook.
Yeah, most people they tend to divide their money equally among different assets, assuming that's sufficient for diversification.
Mm.
But Dalio, he challenges that notion, right? He asserts that true diversification, it considers the risk associated with each investment, not just the dollar amount allocated.
He's highlighting a really crucial distinction there. A genuinely balanced portfolio. It takes into account the volatility and potential losses of each asset class.
Yeah.
Not just the perceived diversification based on equal dollar amounts.
Just simply allocating, 50% to stocks and 50% to bonds might seem balanced on the surface, but stocks are inherently more volatile than bonds, meaning that your portfolio could still be heavily exposed to risk even with that equal dollar split.
Precisely. So Dalio's all seasons portfolio addresses this by carefully balancing that risk across various asset classes like gold, commodities, bonds, and stocks. This strategic allocation aims to minimize losses while generating those consistent returns regardless of the economic climate.
And the results, they speak for themselves. This portfolio has demonstrated remarkable resilience. It's delivered consistent returns over decades, even during those periods of market turmoil. I mean, just imagine an investment that grew by nearly 10% annually for 30 years and only experienced losses in 3 out of those 30 years. I mean, that's the power of a well-structured, risk-balanced portfolio.
It's a testament to the effectiveness of long-term thinking and a strategic approach to asset allocation, right? It's designed to weather various market conditions.
Yeah, and beyond the financial benefits, Robbins highlights the psychological advantages of such a portfolio. Just picture this. The market is in a free fall. Panic sets in. Everyone around you is selling off their their investments, but you remain calm knowing that your portfolio is structured to withstand the storm. That peace of mind, that's invaluable.
It's about achieving not only financial security, but emotional well-being as well, right? Knowing that your investments are strategically positioned to navigate that volatility can provide a sense of stability during those turbulent times.
Absolutely. Okay, now let's transition to the topic of generating income from your investments. Building wealth is one thing, but ensuring that it lasts and provides for you throughout your life, that's equally important, right?
This is where the concept of lifetime income comes into play, especially in an era where traditional pensions are becoming increasingly, rare. You're no longer relying on an employer or a pension fund to provide for your retirement. It's your responsibility now to create that sustainable income stream.
And Robbins, he dives into the world of annuities, which is a topic that often sparks debate. He acknowledges that some annuities are indeed riddled with high fees and penalties, making them less than ideal investments. But
But there are specific types of annuities that can serve as a valuable source of guaranteed income throughout your life, effectively acting as a personalized pension. It's crucial to distinguish between those different types and to thoroughly research any annuity before making a commitment.
yeah, he specifically mentions fixed indexed annuities,
Hmm.
which offer this unique blend of growth potential and downside protection. Could you explain how those work?
Of course. A fixed indexed annuity, it provides a minimum guaranteed return. So that ensures that your principal is protected from market losses, and simultaneously it allows you to participate in market gains up to a predetermined cap. So this means that if the market performs well, your investment grows. But if the market declines, your principal remains safe.
So it offers a level of security that's particularly appealing to those who are risk averse or seeking a more predictable income stream
Yeah.
during retirement, right?
Exactly. It's a way to participate in market growth without being fully exposed to its volatility.
Yeah, and Robbins really emphasizes the importance of doing your due diligence and understanding all the intricacies, before investing in any financial product, annuities included. He challenges that misconception that all annuities are inherently bad. He suggests that they, like any financial tool, can be incredibly beneficial when used correctly and aligned with your specific goals.
Yeah, it's about moving beyond generalizations and carefully evaluating each financial product based on its individual merits and suitability for your unique circumstances.
Absolutely. Now, this next part, this really resonated with me. Robbins, he takes us beyond the realm of investing and delves into the importance of mastering yourself for true financial success. He posits that we often create self-imposed limitations, right, with
Yep.
our beliefs about money, and that hinders our progress.
Yeah. Our mindset is so powerful. It really shapes our financial decisions and outcomes. If you believe that wealth is scarce or unattainable, you're less likely to take the necessary steps to achieve financial abundance.
He refers to it as the power of our story,
Yeah.
the narrative that we create around money, wealth, and our own capabilities.
Mm.
And if our story is filled with limitations and fear, we're likely to perpetuate those experiences. Robbins urges us to shift our mindset from scarcity to abundance, right?
Yeah.
From fear to empowerment.
It's about recognizing that our thoughts and beliefs have a tangible impact on our reality, and by transforming our internal narrative, we can
Right.
we can open ourselves up to new possibilities and opportunities.
Absolutely. And he offers this practical advice on how to make this shift. And he draws upon, his extensive work in personal development. It involves actively challenging, those limiting beliefs, focusing on what you can control,
Mm.
and taking consistent action toward your goals.
It's about moving from a passive to an active approach to managing your finances. It's
Mhm.
about taking ownership and making conscious choices that align with your desired outcome.
Yeah. And he even shares a personal anecdote about a time when he lost everything financially. And this experience, it forced him to confront his own limiting beliefs,
Yeah.
right? And reevaluate his priorities. And he ultimately discovered that financial success is not solely about accumulating wealth. It's about living a life, filled with purpose
Yeah.
and aligned with your values.
It's a powerful reminder, isn't it, that true wealth encompasses, more than just money. It's about aligning your financial goals with your values and striving to create a life that is both fulfilling and abundant.
Absolutely.
Yeah.
Before we delve further into Robbins' wisdom, let's shift gears a little bit and explore some insights from the other sources you've provided. These materials are packed with wisdom from legendary investors like Warren Buffett, Paul Tudor Jones, and David Swensen, and their perspectives offer a fascinating glimpse into the minds of those who have achieved remarkable success in the financial world.
I'm eager to dive into their insights. Their experiences and strategies can provide valuable lessons for us all.
For starters, Warren Buffett, often hailed as the Oracle of Omaha, is a staunch advocate for index funds. I mean,
Yeah.
he's even instructed his own family to invest in index funds after his passing. That's a powerful testament to his belief in their long-term effectiveness.
It's quite a statement, isn't it? Especially coming from one of the most successful um, stock pickers of all time. It speaks volumes about the potential of index funds as a simple yet powerful investment strategy.
Index funds are essentially like owning a tiny sliver of all the companies in a specific market, like the
Yeah.
S&P 500, and they provide instant diversification, which mitigates risk by spreading your investment across a wide range of companies. Buffett, he emphasizes the importance of investing in great American businesses and holding on to those investments for the long haul.
His philosophy really aligns perfectly with the principles of compounding that we discussed earlier, right? It's a strategy that prioritizes patience and a long-term perspective, allowing your investments to grow and compound over time.
Okay, now let's turn our attention to Paul Tudor Jones. He's a hedge fund manager renowned for his accurate prediction of the 1987 stock market crash.
Yeah.
What makes his approach so intriguing is his unwavering focus on risk management.
He's known for saying that defense is 10 times more important than offense when it comes to investing, right? Preserving capital is paramount in his strategy.
Early in his career, he experienced that devastating speed at which wealth can vanish, and this experience really profoundly shaped his investment philosophy, instilling in him the importance of protecting capital above all else.
That's a crucial lesson for any investor, regardless of experience or portfolio size, right? Safeguarding your capital allows you to remain in the game and seize future opportunities as they arise.
Absolutely. Jones also emphasizes this concept of asymmetric risk reward, meaning you should only pursue investments where the potential upside significantly outweighs the potential downside. It's about strategically placing your bets where the odds are in your favor.
It's a calculated approach to risk taking. It's about understanding those potential downsides and ensuring that the potential rewards justify those risks.
Yeah, he applies a rule of 5 to 1, meaning he'll only risk $1 if there's a possibility of making $5. So this way, even if he's wrong 80% of the time, he still comes out ahead.
That's a fascinating approach to managing risk and maximizing those potential returns, right? It highlights the importance of being selective with your investments and only pursuing opportunities where the potential rewards justify those inherent risks.
Exactly. Okay. Last but certainly not least, let's explore the wisdom of David Swensen, the chief investment officer at Yale University. He's widely regarded as one of the most accomplished institutional investors globally, having managed Yale's massive endowment, which has consistently outperformed the market for decades.
Swensen's approach, what stands out? It's his long-term perspective and his commitment to diversification across a diverse range of asset classes. He doesn't limit himself to the traditional stocks and bonds. He ventures into realms like real estate, private equity, and even natural resources.
It's a sophisticated approach that transcends that that conventional 60/40 stock bond allocation. It seeks to capture returns from a wider spectrum of investments.
His strategy reflects this belief that by diversifying across a broad range of assets, you can mitigate risk and potentially enhance returns by tapping into the growth potential of various sectors.
Yeah. Swenson also he passionately advocates for minimizing fees, arguing that one of the biggest blunders that investors make is pouring money into actively managed mutual funds that often fail to outperform the market after fees are deducted. He champions low-cost index funds as a more efficient and effective way to build wealth over time.
His perspective really aligns with the common thread woven throughout the sources you've provided, right? That significant impact of fees on your long-term financial well-being. By minimizing expenses, you retain more of your hard-earned gains, allowing your investments to compound more effectively over time.
Yeah. I'm in awe of the insights these brilliant minds offer. It's inspiring to witness their unique approaches to the game of finance and the principles that guide their decisions.
Yeah.
Yeah, it really shows how valuable it is to learn from people who have achieved incredible results, and their experience and insights can give us such great guidance for our own financial journeys.
Totally. It's like, standing on the shoulders of giants.
Okay, so before we wrap up this deep dive, I want to circle back to those three financial goals that Tony Robbins highlights. Security, vitality, and independence. He really encourages us to calculate the specific income needed to achieve each level. And so it's not about this vague idea of being rich. It's about defining what financial freedom truly means to you.
It's a powerful exercise, isn't it, in self-reflection and goal setting. By quantifying those aspirations, you create a roadmap for achieving them. It transforms those abstract dreams into concrete, objectives.
And he even suggests factoring in, potential sources of income, like Social Security inheritances or any other streams that could impact your timeline. It's about creating that holistic view of your financial situation, right?
Yeah. Taking that comprehensive approach that considers all, potential resources and income streams, it can paint a much clearer picture of your financial future. It allows for more accurate projections and helps refine your strategy.
Robbins also discusses, the importance of managing expenses, and he emphasizes that it's not about deprivation or extreme frugality. It's about consciously aligning your spending with your values and goals. He proposes identifying three expenditures that you could eliminate or reduce.
It's about making those deliberate choices about where your money flows and ensuring that it supports your priorities. I mean, even small adjustments can have a significant impact, especially over time.
Yeah, those adjustments could range from cutting back on daily lattes to downsizing your home or your car. He even encourages exploring alternative living arrangements or locations. I mean, imagine reducing your cost of living dramatically by residing in a beautiful, affordable location, overseas. It's about expanding your possibilities and challenging that conventional thinking.
It's really interesting, isn't it, to consider how lifestyle choices can really influence your path to financial freedom. Sometimes a shift in perspective can open doors to new and exciting opportunities.
Absolutely. Another key takeaway is the importance of increasing your earning potential, and Robbins emphasizes that it's not just about getting a raise. It's about continuously investing in yourself, honing your skills and discovering those innovative ways to provide value to the marketplace.
Yeah, it's about embracing that growth mindset and actively seeking ways to expand your income generating capabilities.
He shares these inspiring stories of individuals who have achieved remarkable financial success, by thinking outside the box and finding creative ways to serve others, and their stories really illustrate that financial freedom. It's not just about luck or inheritance. It's about taking ownership and crafting your own opportunities.
It's about those journeys. They highlight the power of innovation, determination, and a willingness to challenge the status quo.
And finally, Robbins, he reminds us to nurture our dreams He advocates for creating a dream bucket, which is basically a designated portion of your savings that's dedicated to pursuing your passions and aspirations.
It's a reminder that financial freedom isn't just about, numbers and spreadsheets. It's about creating a life that's filled with joy, purpose, and those meaningful experiences.
And this bucket, it could fund anything from traveling the world to launching your own business to finally enrolling in that cooking class you've always dreamt
Yeah.
of taking. It's a powerful reminder that financial freedom ultimately grants you the freedom to live a life that reflects your deepest desires.
It really captures, the essence of financial well-being, right?
Yeah.
Designing a life that's rich with both material abundance and personal fulfillment.
Okay, so as we wrap up this deep dive, I want to leave you with this. What resonated most with you today? Which strategies are you eager to explore further? Remember, financial freedom, it's a journey, not a destination. Take that first step, no matter how small. Set up an automatic transfer to your savings account. Research low-cost index funds, or even just take some time to calculate your financial goals.
Every journey begins with a single step.
You got this. Armed with the right knowledge and a positive mindset, you have the power to master your finances and create the life that you envision.
I think this deep dive has really given you some valuable insights and those actionable strategies. And now it's time to put that knowledge into practice and embark on your path to financial empowerment.